Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of markets that really don't make any sense. And if there's any doubt in your mind, let me give you this. Foxconn, which is Apple's largest supplier, has shut down their factories because of the coronavirus. Their stock has dropped 10% over that. Apple stock has gone up. Does that make any sense to you? How can Apple make money if they run out of inventory, if their supplier is not building parts? How is that bullish for their stock? You say, well, it has to be because the market's going up. See, a long time ago, meaning prior to the great financial crisis, humans pretty much control the markets. We had human traders. We had what are called prop desk people who, if you ever watch those Wall Street movies with the big floors just full of traders and computers, they made the market. So when people came and sell, they would choose to buy or sell with their company's money. And they were called the prop desk. Well, those are all gone. We're now in a computer control world where 80% of the market is indirectly or directly controlled by some sort of algorithm, where it's in a black box plugged into the internet and it's trading on its own based on whatever programming assumptions it's given, or you have totally formulaic strategies, which are again managed by computers that say, hey, if these events happen, stock prices are going up, well, then we buy more. If prices go down, we sell. It just depends on what the formula says. And so what's happening in the market today is these machines, because most of them, again, are based on a formula. They're not looking at the news and saying, hey, Hyundai and Kia shuttled their factories for a week, but what if they don't open? And why did they shuttle them? Because their supplier in Wuhan, Wuhan, isn't making parts. Well, that could be a problem. But you don't see that in the market because these computer algorithms don't care. They don't know and they don't care. And I want to share with you an article that ran on Zero Hedge today that says these computer programs, not only are they at maximum equity allocation, they appear to be wanting to increase that, taking on more and more risk. And what happens to markets when you have a weakening economy and excessive leverage? Well, we've seen that before. It's called market crash. So let's take a look at this article. You can go to zerohedge.com. It's titled "An Unexpected Catalyst Emerges to Push Stocks to a Fresh All-Time High." And we look at equity position is very high at 85% according to this piece here, this consolidated equity position graph. But let's go on and see what we can find in here. And you remember we talked about, was it Friday, that the markets had to close over a certain point and they didn't, and the dealers would flip to their selling. Well, what happened is the very next day, stock prices gapped over that, so to make sure they didn't sell. But now we're going to look at risk parity models, which are sitting at an unprecedented 65% equity allocation in terms of their beta to the S&P 500, which means they've never had a larger exposure to stocks. Now, some people kind of looked at this chart and would say, hey, somewhere when these strategies get between 50 to 55% in equities, they pretty much run out of steam. Well, now they've shot straight up from there. And a lot of people, in fact, says it was virtually impossible for that to happen. Well, it turns out it did. And Charlie McGellick of Nomura goes in here and says, hey, there was this volatility event that happened February 5th of last year or 2 years ago, which called a vol blowout. Well, some of these strategies have a 2-year look back on volatility. And so what he says is there will be the opposite move effectively taking place, a slow-moving gross up as trailing realized vols drop and signal releveraging from equities to rates to credits to commodities. Now, it's important to note, now when these risk parity funds sell and all these generally other strategies, what are they selling? Well, they're selling bonds to buy stocks. That's generally what they're doing. So keep that in mind. They're selling bonds to buy stocks and they're at extremely high equity allocations. So it says, this means despite having a record exposure to stocks, risk parity funds will lever up even more and purchase tens of billions of more equities simply because an event that took place 2 years ago does no longer impact buying programs, vol targeting signals. So while Charlie isn't suggesting that it will guarantee stock prices will go higher, what he's saying is essentially, based on what he knows, this is something that could push stock prices even higher. And down here it says may serve to push stocks to new all-time highs. And this is interesting because, like I said, they're selling stock, or they're buying stocks to sell bonds, and they're basing it completely on algorithms. So again, they don't care about the news. And this is a problem because when you have excessive leverage and you have a stock market that seems to defy what the news is saying, it tells people that everything's okay. And you got to understand who are what group is the major investors. It's the baby boomers. And what have they grown up knowing is that humans make the market. I mean, every book, everything you read about says, hey, when you hear this in the news and the markets go up, it means it's either priced in or it's not a big deal, or the markets are already looking for something else. When computers are trading it, you get the same feeling. It makes you feel good. Oh, look, there's this coronavirus. Can't be that bad because look, the S&P 500 went up because the computer programs don't know. Yes, some of them, a small number of them are reading the news, but a majority of these are based on a formula that doesn't have news written in it. It just says, hey, our market's going up and volatility is dropping. Yes, well, buy more. Wait, we're already maxed out. Take leverage. Take more leverage. Take leverage. We don't want to miss out. At some point, when all of this extreme leverage and positioning goes the other direction, what are they going to buy? They're going to buy bonds. Because what are they sitting in? Stocks. What is the opposing trade? What do they go to when stock prices are over, when the momentum and everything shifts and says sell stocks? They go into bonds. And yet Treasury yields are sitting right near their all-time low. Here you have 30-year Treasury yields at 1.905%. Today they're at 2.1, a little over that. I think they closed a little bit higher because, again, my screen is 30 minutes lagged. I don't know why the Treasury market on this program closes 30 minutes early compared to the rest of the market, but it does. So what we know is it's closed somewhere a little above 2.1%. Now, as we look backwards, what we can see is it's running right. It should be running into resistance pretty soon here. And we now know this 2% level of support. That's why I added a purple line. And how do we know that? Because yields came down and bounced off support. Yields came down and are bouncing off support. Is this expected? Absolutely expected. Now, in an ideal world, would we love to see yields break through here? Well, yes, because I think 30-year Treasury yields are headed to 1% or less. And when you look at all that extreme positioning in these computer models, it would suggest there's a lot of ammunition that can come into the Treasury market and drive yields lower. But from a technical perspective, you have people that are very, very short the bond market, which is what we look at every Monday. So if you missed that, tune in or go back and take a look at any Monday video where we talk about how hedge fund managers are positioned, and they're short the bond market. So when you're short the bond market and yields fall, you lose money. And this is kind of like the last point before it gets out of hand. So what did they had to do? They have to come in and defend their position. This doesn't imply that the market data or the global news is inflationary. What it implies is these people are short and they need to defend. So if we go look at TLT, which is the largest Treasury ETF for the long bond, what you see is we broke out of this right triangle and it squeezed the shorts all the way up through here until it got back to the point where it's about to break higher. And that would be a problem because you'd have a lot of strategies that would need to dump stocks to cover their bond shorts. And as expected, we see some defense here of their position because here it is back right near the all-time high, price high. And what are they going to do? They're going to come in and short it. Now, as a bond bull, what I want to do is see that they run out of ability to short or run out of desire to and have it break through and watch them turn into buyers and shoot this off into the next big bond bull market. We can look at volume and seeing that volume here is trading not overly heavily, but compared to lately, it's up there. If I zoom back over 2 years, you can see that volumes have definitely traded quite a bit higher, but it's elevated, above average. And so what you see is as the prices have peaked here, sellers have come in on increased volume and sell. And then as it's gone down, you've seen volume kick up. So what's nice is while there's good volume, that means there's also buyers, because half these are sellers, half of them are buyers. So we didn't see a huge price move relative to how much buying and selling was happening today. But in an ideal situation, we want to see this find price support somewhere near here, which would match those prior highs kind of set right back in here. So it wouldn't surprise me if there's a little bit more selling into tomorrow, but ideally we'd want to see this kind of find support here. Now there are some open gaps that would suggest that this may come down and fill, but there's also open gaps up here too. And now there are 2 more open gaps right above it. So we do know this is going to reverse. Is it likely this is going to come all the way down here? I doubt it, but you can't say that it won't happen. Looking at the moving average, you see over the last 50 days, prices are rising. Last 100 days, prices are rising. Last 200-day, prices are rising. So from a moving average perspective, you're seeing some nice support for people or programs who trade moving average. So like I said, ideally, we want to see this find support. There is a, what's this? I forget, an island gap reversal. And we do know that, so how do we know? Because there's a gap here and a gap here. And this gap was the coronavirus gap. And now we're not concerned about coronavirus gap. But we do know that island gap reversals are generally more than half the time reversed. Occasionally, there are very powerful signals where you'll see prices go down, but we've seen gaps, island gaps get reversed pretty quickly, so we'll expect that to happen as well. Now, I want to switch back to the prediction for tomorrow's payroll report, which will probably be grossly inaccurate. But here you can see the value of manufacturers' new orders for durable goods, excluding defense spending and excluding aircraft or non-defense aircraft and parts. Translation, Boeing. And well, I mean, who builds most of the airplanes? It's Boeing. And here you have total non-farm payrolls on the right. And what this suggests is demand from the consumer, which is in blue on a year-over-year basis, is contracting. It's not as deep as it was in 2016, but it's contracting. And yet payrolls remain fairly and somewhat surprisingly high. And based on the ADP report today, we're looking at a strong January, but it's kind of baffling because 1, consumer demand's fallen, 2, gasoline inventories are rising. Although I will say they did just actually recently, they're not at their peak anymore, but just kind of makes you wonder where all these people are working if demand is falling. And then you kind of also makes you wonder, why are so many homeowners refinancing if all these people are going to work? So let's take a look at ExxonMobil stock. Again, good proxy for the oil industry. Well, let's first look. Crude oil today rebounded off of its lows of $49 and got up to $51. $50 is a very key level of support for crude oil. Let's zoom out a little further. If crude oil does not hold 50, you can go back to 2015, and it implies that the next destination for it is somewhere around 42.5 a barrel. So this is a very strong area of support because this is where a lot of hedge funds and other investors have been buying crude oils at $50 a barrel, or 50 to 52. So today they came in and off the inventory report, which wasn't. Some people say it's bullish, doesn't look bullish to me, but nevertheless, you see that they're coming in to defend that position. Now, from a look at ExxonMobil, we see some increased volume. And increased volume can often signal a bottom, but when you have this big topping pattern, as we do in ExxonMobil, and you have a stock that is widely traded, it's not unusual for a stock to break support and then come back and reconfirm it before going in the direction. Or in this case, you can see back here, it broke through support, came back up and went through support in a bullish move. But I want to point out, this is a weekly chart. So look at all the volume, these cayenne bars. See these cayenne bars? It's saying there was a lot of selling, and that means the big players were coming in and buying. You'll notice here, the trading volume is elevated, but not that much. Nowhere near what it was like here when all of the selling occurred. But unfortunately, energy stocks are not widely owned by the retail public. And so it probably means that our ExxonMobil stock, along with the rest of the oil industry, is headed lower. But if crude oil doesn't hold 50, and that's what you want to watch out for, it says it's going down to 42.5, and that means it's going to take the oil stocks with it. And of course, that should be very bullish for bond prices as well, and I suspect we'll see them turn around pretty quick. So I'm Steve Van Metre. I appreciate you taking the time to watch. We'll be back Friday with our more comprehensive look at the underlying economic data and credit data with my weekly economic update. I'll see you then. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by a sale, security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Own personal capacity opinions expressed in the video that I do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.